Good morning, good afternoon, good evening, depending where you are on this wonderful planet. And welcome to the Monday, the 12th of September, Bull versus Bear webinar. Steve Miley on the call for trade day. First of all, an apology for Friday's webinar. I mean, literally, internet outage sounds like a tall story. It's not a tall story. I was all prepped, had all the tabs open 2 minutes before we were due to start the webinar, and my internet failed. It didn't come back up for about 25-30 minutes later. So deepest apologies for that, beyond my control, and hopefully won't happen again. So here we are this morning. So welcome to you all. I'm going to go for our usual regular run through, but a slight different going into today, given that we have the Monday, and saying on the Monday, I tend to take a look at what I like to call the shape of the week. So the shape of the week being what's going to happen in the week from a macro fundamental basis. Even though we're day trading here at Trade Day, it's really useful, I think, to take a look at how the market is setting up for the week. Where the important potential volatility points after the week, and because that can have an impact on the days before that. If you've got a lot of information coming maybe later in the week, then maybe early in the week you're going to have less volatility, narrower ranges, and so you might adjust your outlook and trading style earlier in the week because of that, and vice versa, right? So first of all, let's take a look then. A quick recap from last week. So generally speaking, we got this it was no kind of one single categoric event, right? But we definitely we saw a shift to risk on across the board, across asset classes as well. Okay. And that was from easing inflation fears primarily, and a less hawkish tone. And where did that come from? Well, one thing we had, if some of the data, the Fed's beige book indicated that prices are moderating in 9 of the 12 districts. We had oil prices hitting multi-month lows through the middle part of last week. That's going to help as well, taking off inflationary pressures. Remember, a lot of the inflationary pressures that we've seen are coming from higher energy prices, higher electricity prices, higher gas prices, higher oil prices. We also had Brainard and Mester speaking last week. So even though they weren't outrightly dovish comments, they were less hawkish than previous, and they were less hawkish than maybe anticipated. So de facto, more dovish. So again, in here, markets taking that as a positive. So easing inflation fears from lower oil prices, the beige book from Brainard and Mester. And then we had a positive step from European countries, including the UK, on ways to deal with the energy crisis and looking at electricity market intervention. So all of those things in there were positives for the riskier assets. So we went into more of a risk-on environment, certainly through Wednesday through into Thursday, and then an explosion to the upside on riskier assets on Friday, including obviously the stock indices. The other thing we had was, and I think this is important as well, right? The ECB were raised interest rates by 0.75% as anticipated on Thursday. Now, although very much anticipated, it did allow euro versus the dollar to push higher. Now, this is important, even if you're not trading currencies, right? Because of the high correlation. The move that we've seen higher in stocks has been assisted by US dollar weakening, having been super strong, obviously, throughout 2022. So the US dollar's weakened from Wednesday through maybe Thursday, and certainly from Thursday after the ECB. Now, even though this wasn't a dollar event, it was a euro event, right? The ECB were more, well, they weren't more hawkish, but the market were there was a relief. The euro certainly rallied after the ECB rate hike. So we had EUR USD go up, right? Euro versus the dollar went up. The euro strengthened. Now, sometimes because EUR USD, the euro versus the dollar, is the biggest, most liquid traded FX pair on the planet, the two largest global economies, the Eurozone economy as a whole, and the not national economies. You just take the Eurozone as a whole. It's a huge economy, and the US economy, because of that, the fact that the EUR USD goes higher, sometimes that is also seen as then US dollar weakness, even though in this case it actually comes from euro strength. So often when EUR USD gets a significant push to the upside, other currencies also rally against the dollar. So remember, this was being driven by ECB, by the ECB, by a slightly more hawkish tone, by kind of a relief. And so from the euro going higher from the dollar, then that kind of translates, even though it's not because of a dollar reason, into EUR/USD strength, euro strength, translate into dollar weakness. And then the dollar weakened if you look against many other currencies, Australian, New Zealand dollars, Canadian dollar versus the Japanese yen. It's even against the pound. Now, the pound's been a dog. I'm from the UK. The pound has been super weak. Last week, Wednesday, Thursday, it hit its lowest point since 1985 against the dollar. Okay, it broke below the 2020 low. It was at a super low level, only just nudged below the 2020 low, which was 114.10. It went down to like 114.05 and then bounced. But nevertheless, the pound even managed to bounce against the dollar. So the dollar weakened against the pound. So I think all of that's important. Yeah. So the dollar turned right Wednesday through Thursday and certainly Thursday through Friday. And the dollar turning then, a more negative dollar then reflected a more of a risk on mode. And then that also helps stocks on the upside. So, I think that's important, even though it wasn't necessarily driven by anything, that you would see as, super positive. It was a more hawkish, if anything, or as expected, hawkish central bank, European central bank, that actually ended up translating into stock market, equity market strength. So equities were up, European and Asian, as well as US. And interestingly, what didn't turn was US 10-year yields. US 10-year yields continue to track higher. If I go and look, hopefully on here, on the yield chart, no, that's not the one. In here, US 10-year yields, if I refresh this, we did get a slight dip in yields, right? I think Thursday through Friday, but it was so negligible. If I turn this to a candlestick chart, you'll see in here, and I'll pop it out. You'll see in here. So look, so this is now, so we did get this one to move lower on the 7th. So that was Wednesday, right? And then it popped back higher on Thursday and then kind of nomads. So we haven't really rolled back lower. This is the one place that hasn't. Now, if this reverses, I think this is super, super, super important, right? If this breaks below that low there in yield, okay, so that low in yield I've got at 320. If we break 320, and certainly then you got this next one just below this low here, that's at 317. If we break on US 10 years below 320, 317, this becomes a topping pattern. It aims yields lower. And I think that would really, really, this is the market that hasn't turned. If I go and look at what I've got here, right, you had a bounce here in copper, right? If we look at oil didn't bounce that much actually, but it did bounce a bit in here. You had a bearish extension previously in oil. Remember, the bearish extension in oil is good. It's good for the lower inflation. Okay, so that's a positive for stocks in here. If we go and look at what the dollar index did, okay, dollar index rolled lower. Okay, significant. It's a weekly chart. Remember. Significant. And then we look at the other currencies. So look at the euro and the pound, a basing pattern, and they're higher again this morning. Euro's higher this morning, even the pound up. You look at the Australian, I haven't got these labeled, but this is old. But Australian dollar rebounding. So most up, and dollar yen rolled back lower as well on the weekly chart. Actually, dollar yen's nudging back higher. Okay, but what hasn't rolled over, going back here, is on the yield. So sorry, no, wrong one. Going back here is the yield. Okay, if the yield rolls, I really think this. If we get a break below 320, 317, okay, in the next few days, then that's going to be a really significant development. We go to lower yields that are really bolster the risk on mode. Okay, and if you want to know where it is on Treasuries, okay. If I go to here, and I'm going to have to switch chart here. So where are we on Treasuries? So it needs to get above these peaks here and here. Okay, so we've got on Treasuries on 10-year, on the December contract on 10 years, we are at, where's the data box? So we are at the high there is 116.23 on deck and 116.27.5 above those. And obviously we're some way away from that, but I think you really need to keep your eye on those levels. going into maybe today, maybe late today, probably more likely tomorrow, and we'll talk about that now. So now actually going back in here to our weekly stuff. So that's what's happening on all the markets, right? Where's the big event? The big event is here, US CPI tomorrow. Okay, we've got a load of UK data. That's obviously not particularly impacting on what you guys are trading. We've got tons of UK data this week. We get German CPI tomorrow. Well, it's probably very early in the US session for you guys in the US. And then we get German ZEW. So I could actually, and we'll come through that. But the big data for the week is going to be the US CPI. We then get UK CPI, but say got German CPI, UK CPI as well on Wednesday. And then we get US retail sales is the other number. But really, US CPI, all eyes are going to be on that going into this week. The other thing to mention is we've got the Fed meeting next Wednesday. From this weekend just gone, the Fed are in their embargo. They're in their blackout period, right? So we've got no Fed speakers. And generally speaking, the Fed speakers have been fairly hawkish for the last, at least the last, 2, 3, 4 weeks post, Jackson Hole and even before Jackson Hole, right? So we're going to have a respite from that hawkishness. We're not going to get none of that hawkish jawboning from the Fed, right? So we're not going to get any of that coming through for the next week up until the Fed meeting next Wednesday. So that's kind of going to ease that. So we've got no central bank activity of note this week. The big standout is going to be US CPI coming tomorrow. If I go to what we've got today, you said we've had this UK data already, slight dip in GDP data and industrial production data. If I go to tomorrow, you do get the German data. So that's very early. It's 2 a.m. For you guys on the eastern side, on the eastern time. Okay, so it's 2 a.m. So we do get German data, and then obviously we've got the CPI data. All eyes on that CPI data, particularly the core. The core is probably more watched, but then again, we got the headline as well. So 8.1 and minus 0.1 on the year-on-year and month-on-month, 0.3 and 6.1. On the core numbers anticipated. So we're certainly going to be watching out for all of those. That's going to be really important going into the week. Right, let's take a look. 5 things to start your day. Inflation data, okay, key data Tuesday, yada, yada. We've already spoken about that. Railway workers will be on strike end of the week in the US. Okay. Energy stocks and bonds are poised to get a fresh boost from investors seem to benefit from the surging electricity prices and fuel storage expected later this year. Stocks higher in Europe and US futures higher. Light session on the data. Okay, so not much from there. Interesting. I think this is a decent little article. I'll share this one with you from the Morning Bid. I'm going to put that into the chat now. I think this is interesting. They're pointing out 2 key things, 2 key turning points. Remember, I just spoke about the markets turning from about Wednesday, Thursday last week. But 2 key turning points in here. Ukraine over the weekend, in case you missed it, right? Big gains, big counteroffensive for Ukraine against Russian troops. Took a big swathe back in the south of the country. A real kind of surprise. And a real positive in here. So that's one thing, okay, that we've seen. So not only have markets turned, but they've been bolstered by this. And obviously, this was one of the big. This is one of the big, the twin and political economic shocks. They're saying turning tides for these 2 shocks, right? One of them is this counteroffensive by Ukraine. The other one, okay, in here, and that's euros higher, as was higher anyway from last week. Euro continues higher, stocks higher, and the other one in here. Actually, it's been inflation, and obviously we've got the critical focus going into Tuesday. Okay, I have a question in here. Who's that from? I can't see who it's from. It doesn't say who it's from. Any tips on converting your TA report levels from the ES to MES? On Friday, we had a 9-point opening gap on MES, but 21 points on ES. 60 tick difference. Yet the ES high of the day was actually lower than MES. Yeah, no massive tip in here. I'm not going to do it on both the minis and the micros, obviously. Just translate it best you can, guys. No massive tips. If the market gaps, you have to try and take that gap into consideration. You can only do what I would say. Yeah, the market is always going to go and look at the most liquid. What's going to make the real move is the most liquid. Now, obviously, there's the full S&P, right? But these days, the ES. I don't know why your name is not showing, Clinton. It's not showing though for me anyway here. It doesn't matter. Hey, Clinton. So I would say what you need to do is concentrate on the most liquid contract, right? That's where when the levels break on the liquid contract, that's where it's going to trigger it in that liquid contract. That will move, and obviously the other contract's going to move as well. So, given that the mini is the most liquid contract, I think what you do, even if you're trading the micros, right? You have both charts open. You have the levels on the minis, but you're trading on the micros, right? So it's similar like with the cash index, right? The cash index isn't massively look, but then when the cash index levels break, yeah, the actual cash index for say the S&P or the Nasdaq, when levels break on the cash index, they might break before or after levels on the futures market, right? But the cash index is looked at less, but nevertheless, you should still be noting. If the cash index is going to break a new high, an old high, before the futures, then it will probably accelerate on the cash index because the market people are looking at the cash index as well. So that can then create and trigger trigger the break on the say the futures and vice versa. So what I would say is the most liquid market. You've got obviously the full S&P. You've got the S&P mini and the S&P micro. Really these days the benchmark contract is the mini, right? So it's where all the liquidity is. You should be basing your level breaks and your entry points and exits on the ES and then translating them to where they are on the micro would be my view. So if the level breaks out, so if the gap, I'd say the gap on the on the mini is more important than the gap on the micro. So you kind of sort of semi-ignore the gap on the micro and you take it, whether the gap's filled on the mini or the gap's not, etc., etc. Does that make sense? Hope so. So yeah, tide's turning. This article in here, anyway. Going back to where we were in here. What else do we have going on? So U.S. equity futures extend rally. So the dollar is down this morning. Okay, dollar is notably lower. Equity is not particularly massively higher, but the dollar is definitely down across the board. Okay, so given that the dollar is down across the board, let me just show where our bar chart. Let me just go here. Actually, I could probably get it from one of the others, but if we go in here, we'll see where FX is this morning across the board. Currencies, here we are. Oh, sorry. Forex, where are currencies? Forex market overview. Oh, so many pop-ups. So in here this morning, you can see dollar index is down in here. Euro is obviously up. Canadian dollar is pretty much unchanged. Dollar yen is actually slightly up, but dollar Swiss down. So the dollar's down across the board. Pound dollar up. Australian dollar. So the dollar's down, as you can see here, pretty much across the board in here at the moment. Okay. So yeah, and that dollar weakness in here, I'm potentially going to translate to even a stronger move higher in equities. What else do we have going on from the tabs in here? European shares are up, euro is up, dollar down. Ukrainian advances not in the south, in the northeast. Sorry, not in the south. I don't know why I said south. In the northeast. Okay. It's interesting. Yeah, it's and it's not been expected. They expected been in a stalemate for some time. Euro climbs most since dollar as ECB hawks help cool dollar fever, and also the as we say Ukraine developments there. And it's not only not that we trade cryptocurrencies, but Bitcoin hit a 3-week high, and that's being helped by the general risk on mode. So we're in risk on mode across the board, and even oil, which has been very weak. Oil is rebounding, obviously, because we're in a risk on mode. Risk on mode, more positive outlook on the global economy. The Ukraine situation means higher demand potentially for oil, so oil is up. Another thing, just to let you know, guys, know I'm not in the crypto world. We've got a really big event coming up Tuesday through Thursday, what's called the Ethereum Merge. I'm not going to go into all the details of what the merge is. I can share some articles with you that I've written on it, but the Ethereum Merge is going ahead. But without needing to know what that is, it's a really, really big deal, and it's potentially a very big positive. Now, a lot of it's already been discounted into the market, but how that goes Tuesday through Thursday, and we should know, by the end of the week through Thursday, is going to be significantly important for the crypto market. It could see a significant push higher in the crypto market, which then could help, riskier assets generally across the board higher. Okay, so yeah, I'm watching out for that one. So what else do I have in here for you guys? So yeah, European bourses, as I've already said, up across the board. We're up between 1% and 1.5% going into this morning on the cash markets. And this morning, as you can see, having been notably up 1 to 1.5% up on Friday, futures are up. Anywhere between 0.2 on the Dow and Nasdaq 0.4 and the S&P 0.4 higher in here this morning. Interesting enough, this keeps climbing higher. This is our FedWatch tool. The 300 to 325 basis point. So the 75 basis point hike continues to climb higher. This is where I thought it would be when I came back from holiday. We were down in the 70s. Now we're in the 90, pretty much nailed on for a 75 basis point hike next week. Right, let's look at some charts in here. We've already spoken about the Treasuries. While we're here, I'm just going to go and do the dollar. So the dollar, significant decline. Look, dollar index on the debt contract sitting right above this important swing low in here. Where are we on that? This spike low, this rebound low in here is at, can't see it. So this rebound low, we've gone down near to it, 107.26.5. We've rebounded from just above there. If that goes, again, this is a much bigger and more negative topping pattern for the dollar. Again, should assist equities higher. Here's oil. Oil's rebounding, as we said in here. Decent rebound on oil. It's taken out this little internal trend line in here, and we'll go to the 30-minute chart. So this kind of little trend line we have in here, we're obviously above that. It's one that comes down through here. Yeah. I'll do it here, do it properly. Going to be drawing a few more of these to get this drawn properly, and we'll extend that out. So we've reversed that, and now you've got a succession of higher highs and higher lows. It's on the 30-minute chart. You can see oil's gone right up to this peak, these important peaks we have here. Okay, so the peak here is, we have peaks here, 87.76, 87.94, and just above 88.02. This morning we've been up to 87.75. Okay, so above 87.76 would be a positive statement, and through 88.02 could see another really big up leg on oil. So I can only suggest playing that from the long side. Let's give a quick nod to gold. Gold flying high, dollar weakness equals gold strength. Yeah, so we're pushing, we're nudged above. See these three little peaks in here, 1, 2, 3 from the last week. Okay, nudging right there at the moment. We'll see it better on the 30-minute chart. So all of these highs here, look, 1, 2, 3, 4, been kind of tentatively playing with those. Now more of a solid push above those. Again, gold for me, only play it from the long side, dollar from the short side. And that obviously leaves us, no surprise, I'm going to be in risk on mode. S&P, another new high in here. Having taken out, just took out that important peak there, that failure peak there. This is on the debt contract. Oh, so on the SEP. Let me roll to the deck on here now. Sorry, guys. I'll get rid of these. So on the debt contract, I'm looking at the debt contract, by the way, from now on, guys. Okay, this week. The liquidity is kind of split at the moment, but I certainly think it's from the debt contract. So I'm going to add that in as well, and then I'll add in the Nasdaq while we're here. Okay, apologies for the slight delay there doing that. Okay, I'm going to get rid of these as well. So we haven't got those cluttering up. Okay, so let's start with the S&P. And here, so yeah, on Friday we took out that peak there. Okay, and obviously on the continuation chart, we've got a gap right on the continuation chart, which you'll see on my charts. Okay, back here, if I go to the reports here on the S&P, you've got the gap. Right, we've got a gap higher in here because of the roll from the, so this is the continuation chart rolling from the SEP to the deck. So on Friday, and we took out, that was the important level there, 40.72 3/4. That was from the SEP contract, but equally we got above that, also the same level there. So in here on the deck chart, that high was at 40.89.5. So we took that out on Friday, and obviously higher again today. And we're not got any real levels. We've taken out that high there. That was on Friday. There's now no man's land. Look, there's hardly anything in here, right? I would suggest, this sell-off from, I think this is Jackson Hole, right? 26th of August. Yeah, I'm pretty sure that is. The only levels that I would like kind of entertain really looking at from my perspective would be Fibonacci. I'll be doing this. This is from the Jackson Hole sell-off, yeah? And we're through the 61.8. So the only level I've got on the top side now, I'd add in 78.6. Whoops. And that's all the way up here somewhere. Where's that? That's coming in around 41.63. Potential target today, right? Little impulse level there as well. Some highs and lows. So certainly up towards 41.50, 60. I think we can hit today on top side. And if we go in here, look at the reports, 41.53, 54. 41.84, 85. I think we can get up certainly to 53.54 going into the day. If we take a look at the Nasdaq in here, going to go straight to the, say on the, switch this one to a daily. Look at the daily as well. Look at the daily in here. So we took out that one on Friday, that peak there. That's on the deck chart. The high there on the deck was, where are we? 12,730 and a quarter. Okay. Actually didn't take that out on Friday. We were short of that on Friday. And so we've taken it out this morning. That's interesting. So the Nasdaq's made a far more bullish statement this morning. We were short of there. There it is, 1277.30 and a quarter. We were short of there on Friday, and we've taken it out this morning, dipped and gone again. Yeah. So I think next break of the high, through the highs, and again you're in no man's land, right? There's the Jackson Hole sell-off, and again we're looking at. I'd go to the fib. So I'd be looking at this from the low. There's the Jackson Hole sell-off. We're not quite the 61.8. 61.8 comes in around 12,700, nearly 12,800, 12,795, and then maybe as high as up here, 78.6, which is 13,016. And if we go take a look at the levels here, yeah, look, 13,0230, and then 960,975, to the top side. As upside targets. So yeah, certainly looking first to hit these targets, maybe as high as 13,000 going into today. Maybe not quite there. I'm not getting too bullish. Why am I not getting too bullish? I do think there's another up leg. Don't get too greedy. Why? Because it's got CPI tomorrow. But I think there's a real threat that over the next couple of days we do go significantly higher. I think we've had, and the market. Remember the short position, the risk off position across the board, particularly the dollar positioning. Right, everyone is so long the dollar. I mean, everyone is on the dollar. Every investment bank, out there is projecting, still higher, more dollar strength. Yeah. So, and that's very crowded trade, what we call a crowded trade. And I think the short stocks is a crowded trade. The longer term money is underweight now, massively underweight on the latest down leg post Jackson Hole because of the more hawkish tone from the Fed. In here, there's a lot of talk about another big down leg in stocks. I think the pain trade is up for me. The pain trade is up. I'm a natural bull anyway. But yeah, I think upside in here. I can only play this from the long side. That's all I've got for you, people. I'm going to wrap it there. I'm going to wish you all a great trading day. Stay safe, take care, and I will be back with you with another bull versus bear webinar tomorrow. Till then,